in which we work together with them, the relationship nature of the success we've had. I'm joined today by David Selznick, who's our Chief Investment Officer, and we're here to talk today about the other segment of the deal that is just as critical to success, namely the financing side. So if you've got good, great equity partners and financing partners, you've got a winning combination. And that's what we have today. I'm privileged to be here today with David and with three gentlemen who represent financiers with whom we've been working over the last several years. They've been there shoulder to shoulder with us through thick and thin. And one of the things that you find when you're dealing with financing, it's a lot behind the scenes. We all get the art of the deal, right? The Donald Trump. It's all about making the deal happen. Well, these are the unsung heroes that work behind the scenes with their team and ensure that we get to our business objectives, we get to the closing, we enhance the value of the business and the value of the investment through the financing structure. So whether it's a quick close to capitalize on some stress point that the seller has, or whether it's incorporating into the debt package some opportunity to capture dollars with which to do capital improvements or add value, or whether it's to capture value out of the property to in turn provide that back to our investors as a result of the improvement and the accomplishment of the business plans that we have for those investments. These gentlemen here have the task of trying to figure out how to make that work in the context of the debt structure. But extraordinary year, David. We had a lot of unprecedented events, but it was really attributable to your help and your support along the way.
Thank you.
So thanks for all you do and thanks for being here.
Thank you.
So I'd like to start off by making the first introduction. Rich, I know I speak for the industry as a whole when I say that there's nobody more respected in the sector of student housing in particular than you are, and we're proud to be part of the relationship with you and Freddie Mac. Would you take a couple of minutes to just tell the audience what your role is and the nature of your relationship and the scope in working with Kayne Anderson?
Sure. Thank you, Frank. I work for a little housing finance company you may have heard of called Freddie Mac. I'm the Vice President of Production and Sales on our multifamily division. I oversee the Southeast region, which extends from Maryland down to Florida and then more or less east of the Mississippi. I also oversee our student housing initiative, and last year was involved with our senior housing initiative, so I was working with Kayne Anderson on multiple fronts. A quick overview of where Freddie Mac finished 2014. First, we financed $28.3 billion of multifamily housing. In the Southeast region that I oversee, we did $7 billion. Senior housing, we financed $1.2 billion. It was our best year in senior housing finance since 2007. And in student housing, we financed $1.3 billion. I'm proud to say that Freddie Mac, we are the largest student housing financier, and our portfolio of student housing loans is pristine. I believe we have one or two defaults on about a $7 to $8 billion student housing portfolio, so it's very good. Also very proud to say that Kayne Anderson was our largest borrower last year at over $800 million. So think about that. Freddie Mac, it's a $1 trillion company. We provide a lot of financing both on single family and on the multifamily side, and Kayne Anderson was our largest borrower.
That's amazing.
They're also our largest borrower in the student housing space. We don't have the exact figure, the total, we're working on numbers, but they are clearly the largest borrower we extend financing to on the student housing side. And the transaction we'll talk about a little bit later really contributed to that, so thank you for that. Kayne Anderson is also part of a select group of ours, which you'd expect, which we call select sponsors. These select sponsors are high quality, high volume borrowers of ours. They were one of the first of about 10 select sponsors that we picked a couple years ago, probably 2011. They're also the only student housing borrower in our select borrower group. We reserve this group for, as I said, our best borrowers. They receive better pricing, anywhere from 10 to 20 basis points. They receive better credit terms. Given our track record with them, their financial strength, we're able to basically bend credit terms a little bit from more or less your standard one-off deal. We're also open to unique structures, whether it's a unique loan structure or what we call a structured finance with these select sponsors. And we'll talk about one of those transactions later in the panel. And then lastly, they have access to the highest levels of senior management at Freddie Mac, but not only on the multifamily side, but also on the corporate management side, which is important in getting deals done.
Thank you, Rich. And I know one of the things in your industry that's very important, has traditionally been the case, is you work through what they call seller servicers,
Yep.
who are banks and non-banks,
Yep.
who actually are on the front lines of sourcing and underwriting those loans and working with you to ensure that it gets into your
Yeah,
pool.
we're not a direct lender, but we work through seller servicers. And to my left is Ty Goulet from KeyBank, one of our top seller servicers. Also, the largest seller servicer in providing student housing loans to us in 2014, and either one or number two in senior housing. So once again, very appropriate. So Todd?
Great. Thank you, Rich and Frank. Hello, everyone. My name's Todd Goulet. I'm with KeyBank. I've been with the bank about 15 years, and I manage multifamily loan production. Just a quick overview on KeyBank. We're a regional bank headquartered in Cleveland, Ohio. Our retail banking network, which many of you may be more familiar with, stretches across the northern part of the country. I guess they call it the contrarian model. Everyone wants to be in the Sun Belt. Someone at KeyBank decided we would be in the Snow Belt.
Or the Rust Belt.
Yes. However, our corporate bank, which really is the largest revenue generator for the bank, is a national platform with offices in 23 cities around the country, and the real estate capital group is the largest segment of our corporate bank. Last year, we closed about $28 billion in commercial real estate loans, which makes us one of the largest real estate lenders in the country. And the model that we built our real estate platform around is really based on the relationship with our clients. We want to be as meaningful as possible with our clients. We want our interests to be aligned, and we want to be transacting business in as many areas and as frequently as possible with our best clients. And that works better for the client because we're able, as Rich said, to get better terms,
Sure.
to get the attention of the most senior people within the bank, to make sure that we're structuring deals that work best for you. I think the relationship with Kayne Anderson started in 2008, right? When
Right.
Frank and Al
Lawrence,
were
Kansas.
buying 2 properties in Lawrence, Kansas. We provided a $20 million loan there, and since then we've done $1.5 billion of loans together,
Jeez.
which is
7 years.
tremendous to see the
6
growth
years.
that you guys have
Sure.
experienced, and great to be part of that. And last year, 2014 alone, we did $625 million of loans, making you the largest and most important client in KeyBank Real Estate Capital
See
last
that,
year.
Frank?
Well,
Not so bad.
We did it. A little $20 million in 2008. Who would have expected
Just
to get to this
625.
point?
So,
Anyway, that's great. It's been a great relationship, Todd. You're one of the best in the industry from what you do, and you've got a great team, and it's always been a matter of how you pull people from across the country to work the process, make it seamless as possible. It's a great collaboration between the two of us, great partnership. Thank you.
Appreciate it. And what have we done? We've done construction loans, bridge loans, lines of credit, loans we placed with Freddie Mac. And a way we try to stay involved is we'll participate in loans with other lenders from time to time. And we did that on a transaction last year with GE Capital, and we'll talk about that a little bit later. But with that, I will turn it over to Jim Seymour of GE Capital.
Thanks, Todd. My name is Jim Seymour. I run the healthcare real estate lending group for GE Capital. We do about $3.5 billion of financings a year. I think what differentiates us a little bit, and you'll get a sense for how we all kind of fit together here for a totality in terms of financing for Kayne, is we do almost all of our lending, we hold it on balance sheet. So of that $3.5 billion last year, almost $3 billion of it we actually held on our own balance sheet, which gives us a lot of flexibility in terms of being able to take deals down of all shapes and sizes. And secondly, all we do is healthcare. I mean, so you heard Al and Richard talking this morning about certificates of need and Medicare and Medicaid. And we got people whose full-time jobs it is to make sure we understand that. And I think what that does is that helps us. We all talk about structuring a loan to a business plan. And we have unique insight into what these guys are trying to do in terms of the execution of their equity returns. And that gives us a lot more flexibility and understanding to take the risks we need to take to structure a loan to that. In terms of our relationship with Kayne, relative to these gentlemen, it's fairly new. I think we started
13.
together in 2013. We're doing all we can to catch up.
You're doing a pretty good job.
Actually, the first transaction we did together was a sale. You heard this morning about the Aston Garden sale. We have a small equity book, which we've been selling off over the last several years. And we met with I think it was actually in a hotel conference room in D.C. with Frank and with Al. And we'd never met them before. And they kind of went through the Kane Anderson story. And they talked about their selection of partners. And like, it was one of the more exciting meetings I've had in a while, because I think, one, held the properties and we felt like we had a buyer. But also we were thinking, given the scope of what they wanted to do in terms of medical office and in seniors housing and what we do from a debt perspective, that it lined up beautifully. And I think really over the last couple of years we've executed on that. We've closed about 19 loans.
It's 19 months.
In
Impressive.
2 years, and knock wood, hopefully by the end of the first quarter there'll be a few more.
And over $500 million?
Over $500 million in value. So it's been great. Been off to a great
Well,
start.
thank you, Jim.
Yeah,
Good to be
listen,
part of
guys, you have been incredible partners, and being in the trenches, I couldn't thank you enough, because it's very difficult to structure a transaction on an acquisition side and then tailor financing for that transaction and do it in a very quick time frame, because you have a short window. And we at Kane, what we pride ourselves on is certainty of execution, and you guys have been tremendous at enabling us to give the certainty that we do. So thank you so much, and we appreciate the support, you being here today. So being that I am the Chief Investment Officer, I think we need to talk about some deals. One, it's more fun. Two, I think it helps us illustrate what our financing activities are all about. So Jim, since you're closest, I think we should talk about Conservatory.
Yep.
Now, Conservatory, if you know or don't know, it's a 1,053-unit senior housing portfolio in 3 markets in Texas. There were 5 properties, 2 in Dallas, 2 in Houston, and 1 in Austin. And this was an undermanaged portfolio. It was owned by really a mom and pop type operator. It was an older lady, very sharp, but not a sophisticated operator. And so we saw the opportunity. In fact, the whole senior housing market saw an opportunity, but fortunately with Mac's relationship and some creative structuring, we were able to figure out how to get it done. And it was 77% occupied at the time. And so we went to Jim. Fortunately, they were the incumbent lender, and we said, Jim, we have a short fuse here, complicated deal. You know, it's a negotiated, heavily negotiated transaction. How can you help us tailor this transaction? So Jim, it would be great for you to describe a little bit how we did that.
Sure, yeah, it was, I remember it was a little bit of good news, bad news from the lender perspective. The good news was, like David said, we were the incumbent lender, and we knew the properties were undermanaged, right? We knew there was low-hanging fruit there. We knew with professional management there were NOI improvements to be had. So that was the good news. The bad news was, as an incumbent lender, particularly one with a substantial loan like we had, it's never easy to lever up, that asset. So we first thing was to get around. And because really what happens is when you got a turnaround property, those kind of going in loan metrics look very aggressive. The stabilized metrics obviously look a lot better. So what we did is we structured the loan with a fairly modest $175 million upfront funding, and then an additional $50 million of what we call earn-out money. So additional loan proceeds that could be achieved upon the achievement of the business plan. So at 50 relative to 175 is a very large percentage. Typically, it's a much smaller percentage of the loan. But that was really the only way to bridge the gap. I think that was probably the easier part. The other piece of it was $175 million of a hold, even though we do hold larger loans than most, was a bit too much for us on a turnaround. So we had that issue, and really, as these guys looked at the longer term financing, the permanent financing, they felt like there were a couple of properties in the portfolio that were probably ripe for a more permanent financing sooner than we normally would do as a balance sheet lender. So again, this is kind of how we all fit together. What they did is they hooked us up with Todd and with Key, and between the two of us, they were able to take $50 million of the initial loan, which gave us a loan size that we felt very comfortable we could get approved in the GE Capital system, and it also put in place an agency lender who could manage the process for Kane of taking those assets that got stabilized quicker 2 or more permanent financing with an agency financing early on in the loan. It was really,
Right.
it worked out great.
Yeah, bringing us in allowed us to become familiar with the transaction so we could watch them along with you guys. And as each of the assets stabilizes and creates some value, you can bring them to the permanent markets, and we can then interact with Rich at the end of the day. And we'll all be involved in a great transaction.
And listen, that transaction was not all peaches and cream. It was very complicated, and it was tough to put all the pieces together and execute. And Jim and I had some very I would say succinct but difficult conversations. But what I love about that is we got it done, and I think the relationship is way stronger because we went through a difficult deal together. We got it done, and it worked out really well. And what is even better is when we bought that thing, it was 77%, and our business plan has us, hitting, $16 million run rate, actually this coming year. And I'm pleased to say that Richard and his team and Tom and his team, they're doing an awesome job. We're now 87% leased, and we're well on our way to hitting our metrics. So, and just a great deal all around.
And it's interesting because when you talk about the metrics and you talk about the earnout that you had in the loan construction, one of the key things of that deal was that, as you mentioned, part of the price that was deferred
That's right.
to the seller. And the seller had a metric relationship for how they would get their payment and the timing of it. And we had to ensure that we had enough buffer, enough cushion
Right.
between the time that we grabbed the value from you, Jim, and we're able then to put the value back to the seller, and obviously capture some value for our investors. So creating that structure and making sure that we had the NOI thresholds in the right places and right timing was a critical part of that.
No question about it.
So there's always, it's a matter of trying to figure out what the flexibility is. Todd, you mentioned learning the asset as you're with it, because permanent lenders don't always have that opportunity. They step into the situation when they're needed and don't have the opportunity to experience the asset beforehand. So it created a nice stage being set for later.
And that's one thing that you guys do very well compared to your peers, is that the people in your organization are all very involved throughout. I'm speaking to your construction people, your asset management people, your acquisitions people, well before you come to me with a loan. And that's unique. It really gets us much more comfortable. We know the story behind the transaction, and allows us to then, hopefully get to the terms that you need at the end of the day.
And it's worked great thus far. Before we get into the next case study with KeyBank, I just want to remind everybody that if you have a question, there's a text, send it to us. We'll pull it up on the screen. We'll be happy to interrupt the flow of the conversation. You don't have to wait until the end to ask your questions, so please feel free to ask questions as we go along. So Todd, speaking about working with the team as a whole and being able to get the insights from a lot of different perspectives, we had a very challenging transactions back in 2011 when we bought a property in LA at USC. That was a brand new property. The developer just completed it, didn't have experience in student housing, was very focused on getting occupancy. Our business objective when we looked at that property was fully occupied, but in really looking at the property and determining what we were willing to pay for it, we had to take into consideration what the market was really doing. And our game plan was, here's a property, beautiful property within walking distance to USC, but the developer, in its desire to get occupancy up, had left a whole bunch of rent revenue on the table. And in our estimation, we thought that those rents could be increased by 17 to 20% over the course of a couple of years. But in order to win the deal, because we weren't the best price, we had to step up to the plate with a hard closing date and no mortgage contingency, which really put us in a tough spot relative to trying to snag that deal at a very good price for our investors. Talk about how we were able to work with you to ensure that we had the comfort level and the pieces in place to be able to close on time with the financing we needed.
Right. Well, example of not every transaction goes exactly as planned, right? There are always surprises that come along. So the intention here was to place the financing at acquisition into the permanent markets, in this case with Fannie Mae. And,
The other agency.
And we had a number of challenges along the way. Number one, it was a very quick time frame to meet the seller's requirements. And number two, while the students were in occupancy, we had retail tenants that weren't in occupancy, weren't yet paying rent, hadn't built out their space. So it wasn't a fully stabilized transaction. And that's one thing. When we're going to the permanent markets, we really want to see the properties all buttoned up and the cash flow in place.
Well, in fact, there were 11,000 square feet of retail, which were five spots, five spaces in there, and we didn't have the certificate of occupancy yet because we were operating under TCO. Not all the work that the developer was supposed to complete had in fact been completed, so we're going through that
Right,
process.
and we really thought everything would come into place in time for the closing, and a few days prior to closing, we had a conversation, said, boy, it really doesn't look like we're going to get there in time with Fannie Mae, and you said, well, we really don't want to go back to the seller and ask for an extension, and we don't know what pound of flesh they might extract for that, so we got to get this done. And so we were able to bring in our partners at KeyBank on our balance sheet who had obviously experience closing other loans with Kane, had recently closed another transaction in California, so we had loan documents all set. They stepped in, and in 3 days structured and closed and approved and closed a loan on our balance sheet. So they closed on the date required, and then as you got your team in place and got the property to a point where it was ready to go to Fannie Mae, we closed a couple weeks later with Fannie Mae.
Yeah, I'll never forget, it was a Friday, the closing was scheduled, and it was late Tuesday night that we realized we were not going to get the permanent debt in place by Friday, and that's when Todd and his team stepped in, and Wednesday, Thursday, Friday, we got it done. That's a testament to his ability and the team's ability to work together across the country and get us what we needed in time to close. And that deal, by the way, was sold to ACC very, very successfully. We achieved the rent increases within a year as opposed to 2 years, and it benefited the fund too with respect to the sale. So, thank you, Todd.
Well, and also it's a transaction that we could have only pulled off with someone that we had great experience with and knew could deliver at the end of the day. So thank you.
So now we want to talk about really it's the largest, most complex transaction that Kane has ever financed. It's the $816 million 17 loan single sponsor financing that we structured with Freddie Mac. And just to give you guys a little bit more detail on the size, it's 17 properties, 13 student deals, 3 senior deals, 1 multifamily deal, 3,800 units, 4 seller servicers, over 100 people working on the transaction. It was an incredible, incredible accomplishment. And Rich, I go back to the relationship, the special nature of the way we conduct business with you. Frank and I flew up to DC to meet with you and David Brickman, who runs all of multifamily, to conceptualize how do we take advantage of all these loans that are coming either a refinance or acquisitions. How do we gain scale? How do we structure something that is mutually beneficial, but obviously best-in-class terms for us and our investors? And so, Rich, it would be great for you to describe a little bit about how we went about it, how you thought about it internally to tailor the deal and give us what we need, but also have a complete win for Freddie Mac.
Sure. I mean, continuing the theme we've heard from the first panel and on this one about partnership and relationship. I mean, we achieved this deal, which is, as Al mentioned, is the first time a student housing has been securitized ever. And it was pretty, unique transaction. But this started many years ago with David and Frank and Al basically talking to us about how can we do some sort of big structured financing on student housing instead of one-off deals. And, at that time we were happy to do one-offs, but we weren't ready for it at Freddie Mac. I don't think Kane had the scope or the scale, but to do a big transaction. But we kept talking, literally over, I'd say, 5 years. And it finally came together. It started in March of 2014. And we had come up with this execution, which we call single sponsor execution, which is one borrower and multiple loans. This transaction had several unique features for us, and I'll run through a couple of them. First, it was 100% student. It started out as 100% student housing. It also started out as a combination of floating and fixed. But as many deals happen and as things change over time, this deal went from, as David pointed out, not just student, but also some seniors, some age-restricted, a lease-up deal in Chicago. And so it moved off that. And then secondly, it had a lot of new construction. So we started underwriting this transaction in April, May. John was still swinging hammers building some of these deals. So we're underwriting it and sizing it based on pro formas, which is interesting. You never know what the end product's going to look like. But we all just kept charging down the way. Next unique factor is they had requested a 10-year floating rate deal. We had not done 10-year floating rate business. We didn't like it from a risk perspective, and there were just a lot of other reasons we didn't want to do it. But we kept the conversation going and agreed, so I think probably about May or June, that, okay, let's do a 10-year floater with 5 years interest only. We did negotiate over the rate.
I think it's important, Rich. You make it sound like it was a smooth flow of conversation involved. I think there were these extreme turns around the racetrack that had us going left and right.
You want what
as we
now?
were trying to, that's right.
Well,
As we were trying to figure out what was the best combination of factors to create the best structure with flexibility, pricing, and so forth.
Oh, yeah, I should not have. It started out as fixed and floating and different loan terms, 10, 7, 5. It's just, people, if you know lenders like everything nice and easy, very in the box, and this was all over, and it was moving and changing, and people were afraid, were like, whoa, whoa. It's just like, hang in there, we'll get there. The other complicating factor in this was we had 4 seller servicers. And so normally when we do these single sponsor transactions, we'll just work with one sponsor and one seller servicer, and we're able to communicate directly to the seller servicer, who then communicates to the borrower, as we're not a direct lender. Well, with 4 seller servicers and trying to coordinate conference calls. Anyway, long story short, David and I we set the conference calls up every Friday at 1 o'clock, and then sellers could participate or not participate, but we were going to basically hammer the deal out between ourselves and sort of pass the terms down to the seller servicer. Different. I'm not sure how well the seller servicers liked it, but it worked.
I said, well, sorry, man, you're sort of sitting this
Just
one
tell me
out.
what to do.
Well, the seller services liked it from the perspective that it was very important to us, given the relationships we had with these seller servicers, to keep them in the loop. We didn't want to have to pick one and exclude the others, because we've been working actively
right.
with them, and they all had the construction financing on these new developments. So I think from that perspective, it put them all in the position of recognizing, well, thank you. You didn't just exclude us, you tried to figure out a way to incorporate us.
And one thing that we did, which was really smart, and I think, Rich, it was your recommendation, it was to have the same law firm, which is good news, bad news. So they had 17 loans to close. And so, the people that were working on this transaction know that I was calling, Russell was calling, Allison was calling, because everything was time sensitive, needed to get done. And this one attorney who's wonderful and did a fantastic job, but he didn't respond to a couple emails, a couple calls. I'm like, what's going on here? I keep calling the guy, and then he finally responds, David, I'm at my 25th anniversary dinner.
Yeah.
I will call you later. I'm like, okay, cool. And I said to Freddie Mac's attorney, was it your 25th anniversary too? Question mark.
He did not appreciate that.
Did not
at all.
respond.
Yeah. He didn't appreciate it.
Of course, some of us, like my dear wife, we're going to be 25th. She knows not to worry about the
I
25th
didn't
wedding
know.
anniversary.
I was getting a deal done, But anyhow, it was an incredible accomplishment, and we are so thrilled to have you all as partners, and your teams were awesome. They, even at 11 o'clock, 12 o'clock at night, Todd, Kristalina and the rest of the team, they were there, responsive. So, and I just want to say one thing. Rich has the best team in the country. They were my best friends throughout that deal, and I couldn't thank you guys enough.
Thank you.
Thank you. It was excellent. David, I see we have a question for the panelists.
This is such a lock on this question, but go ahead, Frank.
Well, I know it's on everybody's mind. Every year there's the prediction rates are going to go up and so forth. The question is, what's the outlook for U.S. rates? And talk about our return expectations with respect to a rising rate environment. So let's start with the million-dollar question. Are rates going up this year? Which is, we've been asking for how many years now? And I just want to mention that our deal back, and remember we did the early rate lock in Baton Rouge?
Right.
And it was 2011, I believe. And we thought we were heroes, locking rate 6 or 8 months before the close at 6.1% all in. And
good
then,
rate.
like 14 or 16 months later, we
For us.
closed the deal, and I think all in, it was the lowest point, it was 3.7. So where are interest rates going to be this year? Who has the answer? Anyway, why don't you
I'll
talk a
just
little
say,
bit
you know,
about what you're seeing?
So, for my predictive abilities, we bet at the end of the year what rates will be. I picked 3%. That was the number. Everyone went 3% up, over under. I think mostly everybody at Freddie Mac took the over on 3% for 12/31/14. Oops, we missed that one. Who would have thought 180? Who knows? I mean, I will tell you what we are focused on is spreads, and we think spreads on commercial are going to widen out. They're pretty low. They're pretty compressed. We think they're too low. But then we also come back and say, where also investors going to put their money? Real estate provides, and particularly multifamily, provides a pretty solid, great return relative to alternative investments. So does that then keep the pressure to keep spreads down? I know we widened our spreads out twice at the beginning of the year, just a little bit, about 10 or 15 basis points, and we think that will continue, or we're going to try and continue in a competitive market.
Rich and I always have this discussion about spreads widening and narrowing, and I just keep saying, well, if interest rates rise, the spreads narrow. If interest rates drop, the spreads widen. There's kind of a benchmark that they're trying to, or band they're trying to stay within. It works that way. But interestingly enough, we're looking at deals from the perspective of where are we on both the equity and the debt side. And we're looking for a targeted return, as we talked about in all our discussions with you all. And so it's a dynamic thing. It's not like we're sitting there and structuring a deal that somehow is going to be changed in 6 months. We have to take into account where we are today, where the debt financing is, what the structure is. We try to build in flexibility that will allow us in a rising rate environment to have the ability to convert from a floating rate into a fixed. We have caps in place to be able to hedge against rising interest rates environment. We go through transactions, we're structuring the deal to anticipate what's on the horizon with respect to the environment. And so as a result, the structure changes, the pricing changes, but it's all in collaboration with both our equity partners and our debt partners.
Yeah.
Speaking of debt partners, David, why don't you, we've got a question here about working
sure.
with debt partners and the difference.
Yeah, so the question is what's the difference between really the three gentlemen, well, really the firms that these three gentlemen represent. So balance sheet lender, which KeyBank has a great balance sheet really for bridge and construction loans. And with the bridge, it's really not a long-term bridge, really within 2 years, or really best at. And Jim, their balance sheet program is not as bridge-oriented, although it is more interim financing. It's 5 years, and we talk about some 7-year financing. But what these balance sheet lenders are really able to do is tailor financing that with earnouts and TILC reserves and a lot of optionality that permanent lenders can't do. Because for Freddie Mac used to have a balance sheet program, but really now all loans, floating or fixed, they get bundled up and sold. So really, you're locked in. There's not much. After that, you build in your flexibility up front, and we like floating rate paper because it's lockout for 1 year, 1% prepayment, but if you don't like the financing or the environment changes as Frank described, we can go to a fixed rate instrument. So, go ahead.
Yeah, because it's just another advantage. I mean, we're secure. We were a portfolio lender. We've moved to securitized lender. We can do any loan size. So we're in the middle of processing an $850 million single loan. If you're a balance sheet lender, that's very hard to do. It takes up a lot of capital. Because we're a securitized lender, we get sale treatment on our securities, which means our capital requirements are significantly lower than we would be as a balance sheet lender. And with Basel III kicking in for different firms, that's significant. So we move from, as we say, a storage company, balance sheet lender, to a moving company, securitized lender.
Well, and I think this has evolved over the years, which is why we built relationships with different types of lenders so that for each unique situation, we have the ability to capitalize it.
No question.
And I would, Frank, for a mid-sized bank, we're a $100 billion bank, for us to have a meaningful relationship with a company that's growing like yours is we have to move our loans quickly. So we're going to do construction loans, we're going to do short-term bridge loans, and then we're going to move them off to Freddie Mac. And that way we can retain the capacity that we need to continue to transact business together.
It's a great program, and as Frank said, the diversity of capital that you provide us is incredible and really important for executing our business plans.
And you guys need all three. I mean, you need all three, really. To execute what you're trying to do, you need all three.
No question about it.
The one downside, so someone asked, what are the disadvantages of working with a securitized lender? To be honest, it's service after the sale, and it's something that we at Freddie Mac are determined to improve. We're trying to, as everyone's heard horror stories of CMBS servicing. We're determined to basically improve that. We've got a Freddie Mac servicing standard that we insist that any master or special servicer follow our servicing standard, not their own. And we think that, David Brakeman, who heads our group, is a very confident man, and he is determined to basically change the way securitized servicing is done. And so that's somewhat of a disadvantage.
That's great. Thank you all very much.
Thank you.
We are going to move now to the next panel, but first, Terry Quinn, please come up to say a few words.